Does tax frighten you? Does it make you have sleepless nights? Well, it shouldn't, and I'm going to show you why. Hi, I'm Colin Sweetman from First Accounts, and today I'm going to show you the main taxes you need to know when you're running a business in Ireland. Everything from registrations to filing returns. If you're in business, dealing with tax is practically unavoidable, and it doesn't matter if you own a company or if you're in a sole trade business. Everyone needs to look at taxes. Here are the 4 main taxes that you need to be aware of in business. Income tax, corporation tax, for limited companies only, value added tax, and employment taxes. I'll also go over tax relief that could save your company money, like the R&D relief, and I will also very briefly discuss some other minor taxes you may not have heard of before, such as relevant contracts tax, withholding taxes such as dividend withholding taxes and professional services withholding taxes, and the close company surcharge. The only difference between income tax and corporation tax is that income tax is generally for sole traders, while corporation tax is generally only for limited companies. You only really need to be concerned with VAT if certain thresholds are being met, and you also shouldn't worry about employment taxes unless you're employing people in your business, or if your company pays you a salary. Let's get started. Number 1. Registration of corporation tax and income tax. You need to register for corporation tax within 4 weeks of making your first sale in a limited company. And if you don't make any sales, you still need to register for corporation tax within 12 months of registration. So, how do you register for this tax? Well, after you incorporate your business with the company's registration office, you should receive a 6-digit number which you can use to register for taxes with Revenue Online Services. This will also allow you to invoice your customers. If you're a sole trader, you don't really need to talk to the CRO or the company's registration office unless you wish to register your business name. But you will need to register yourself with the Revenue Commissioners on ros.ie using your own PPS number. To register yourself as a sole trader in Ireland, you need to register for income tax. You can do this through the Revenue's e-registration platform, or you can sign the online form called the TR1 form. Number 2. Filing obligations for corporation tax and income tax. Once your company is registered for tax, you will need to be aware of the filing deadline dates. As Ireland operates a self-assessment filing system, you are responsible for calculating, preparing and paying your taxes on time. You can of course outsource this work to an accountant, but still it is your responsibility to ensure that it gets done. You will need to file your first corporation tax return 8 months plus 23 days following the year-end date of your company, but only if you file electronically. Your first year-end date cannot be more than 12 months after incorporation. And we have a spreadsheet that can calculate these dates for you, which you can download from the learning platform. And I will show you how to use the spreadsheet right now. Here is the spreadsheet, and as you can see, all you need to do is enter in your incorporation date. So let's just put a random date, the 15th of February 2022, a few months ago. Let's say we want to have a year-end date of the 30th of September. That can be possible too. And it will return your financial statement start date, finish date, your annual return date, and your B1 filing deadlines and corporation tax filing deadlines. If you are a sole trader, then typically you would file your previous year's return by the 31st of October in the current year. Preliminary tax needs to be paid within 10 months and 23 days of the year-end date within the current period. If you paid too much, you will get reimbursed. If you paid too little, then there will be a balance due to be paid. You will also need to keep accounting records for a minimum of 6 years in case you get audited by the Revenue. Failure to file or pay your taxes on time can result in penalties and interest. And calculating your income tax or corporation tax can be a very cumbersome task. This is why many businesses choose to hire accountants to do this task for them. Because penalties can be between 5 and 10% of the tax owed, plus interest at a rate of 8% per year. In Ireland, companies pay 12.5% tax on taxable profits, while sole traders can get taxed up to 40% of their profits. Good news for startup companies: if your corporation tax bill is less than €200,000, you don't have to pay preliminary tax in your first year of trade. Instead, you do it when you file your first corporation tax return. For sole traders, it's slightly different in that you have to pay USC and PRSI on top of your normal taxes. And you can choose to pay 105% of the preceding prior year accounting period actual liability, or 100% of the previous accounting period's actual liability, just calculated, or 90% of the current accounting period's estimated liability. 3. All about VAT. VAT registration is mandatory for all businesses provided certain conditions have been met. The thresholds are currently €37,500 if you sell in services and €75,000 if you sell goods, but this is within a 12-month rolling period. So for example, if I have an e-commerce shop and I have €70,000 of sales by 6 months, then it's pretty certain that I will meet that threshold and will need to register for VAT. Once you breach or are about to breach this threshold, you need to register for VAT immediately. And once you've registered for VAT successfully, you need to start applying VAT to your sales and start regularly filing VAT returns. If you haven't breached this threshold, then you do not need to register for VAT, but you can still elect to do so if you wish. But why would you do this? Well, for one, if you were pre-sales, then you would be able to get a refund for VAT paid on expenses. It is also beneficial from a sales point of view, as your customers will be able to claim back VAT from their costs, assuming that they are also VAT registered businesses, of course. And it's also important to note that depending on which services and goods you are selling, different VAT rates may apply. For instance, nappies are rated at 0%. And I've put a link in the description below where you can find out these VAT rates. In general, VAT returns are done every 2 months and need to be filed online by the 23rd day following the last day of the current VAT period you are reporting on. On the VAT3 form itself, you simply enter the amount of sales VAT you collected in box T1 and the amount of VAT you claimed on expenses in box T2. The difference is either paid to revenue or refunded to you. Now, filing VAT returns is the easy bit. The difficult part is ensuring that your bookkeeping was done correctly and that you followed all the rules as necessary. Of course, the VAT doesn't just stop there. If you have B2B sales to other VAT registered businesses in the EU, then you will need to register for and file VIES returns each quarter or annually. If you sell B2C to European consumers, then you need to register for one-stop shop and charge European VAT rates on your goods or services. This generally only applies if you break the €10,000 threshold, however. Also, each year you will need to file what's called a return to date or RTD return. This annual filing doesn't mean that you need to pay extra VAT, but you need to have these returns filed, otherwise revenue can use this against you and not pay out rebates that are owed to you. Number 4, employment taxes. If you plan to hire staff, then you will need to register for employers' PAYE before you hire them. You can register for this tax on ros.ie yourself, or you can simply ask your bookkeeper or accountant or payroll provider to do so on your behalf. Be careful though, if you're doing payroll yourself, you will need to use a software that abides by Revenue's PAYE modernization system. As an employer, you are required to collect your employees' taxes on behalf of the government every month or every quarter. It is also important to note that the salary figure you offer to your employees won't be the cost to the company figure. You also need to pay employers' PRSI on top of that salary. Of course, proprietary directors like yourself maybe do not need to pay employers' PRSI. Let's look at an example. Okay, and this is our income tax template, which you can use to find out how much USC, PRSI and PAYE your employees will pay. It is also good to demonstrate how much employers' PRSI you may pay as an employer. So if I was to employ a new staff member and let's say pay them €30,000 per year, then my employer's PRSI will be 3,315, meaning that the cost to the company will be 33,315, not 30,000. This means 2,776 is what will appear on your profit and loss each month under the employee expenses. It also means that you will need to collect USC, employees' PRSI and employers' POE on behalf of the government. This comes to 654. This means that immediately you will need to pay your staff member 2,120 and you will need to pay 654 in the month following payroll to the tax office, to the revenue commissioners. Number 5, other taxes. You may come across other taxes depending on what your business is doing or who your customers are. Capital gains tax may apply on gains from the sale of capital assets. For example, if you sold part of your business premises at a gain, then the gain may be subject to CGT. Relevant contracts tax. This withholding tax may apply if you operate in the construction, meat processing or forestry businesses, or if you make payments to subcontractors in those sectors. Dividend withholding tax. This withholding tax applies to companies that pay dividends or make other distributions to their shareholders. The shareholder receiving the dividend may then be able to claim a credit for the withholding tax when filing his or her tax return. If you supply certain services to the state, including semi-state bodies, PSWT will be withheld from the payments you receive. Remember that this will have cash flow implications, as you will not recover PSWT until you have submitted your year-end return. I have one last tax that may catch professionals out by surprise. This tax is called the close company surcharge. This is designed to discourage the retention of passive income, such as from investments and rental properties, and professional services income, like accountants, lawyers and engineers, but only in close companies. A close company is an Irish resident company that is controlled by 5 or fewer participators. The surcharge takes the form of an additional corporation tax of 20%, or 15% in the case of professional services companies, if the close company has not distributed the relevant income in the accounting period or within 18 months of the final day of the accounting period. The only way to avoid the surcharge is to ensure that there is no profit left over. And this is done by making a distribution via dividend, or putting the money into a director's pension scheme, or by simply extracting it from payroll. Number 6, tax rebates. Research and development relief is really the only relief worth talking about here. The research and development relief, or R&D claim, is available to companies within the charge to corporation tax in Ireland. In order for Irish resident companies to qualify for this relief, they cannot have claimed relief in different countries. In simple terms, R&D can be used on basic research costs, applied research costs, and experimental development, but only in the fields of the natural sciences, technology and engineering, or medical and agricultural applications. Number 7, tax planning. Most taxes are payable as a liability in arrears. This is amazing for cash flow, but it does mean that you need to make some forward planning in your budgets to ensure that you're not caught out by surprise. It is vital that you understand and plan for this impact on cash flow and make sure that you register for the necessary taxes that apply to your business. The taxes that are applicable to your business very much depend on what type of business you are running. You should also consider the need to engage with a professional tax advisor at the very beginning. Well, that's it for this episode. We hope it was useful to you on your business journey. If you have any questions, of course, please feel free to comment in the comment section below, and hopefully you'll watch the next episode and it'll be equally as useful to you. See you in the next one.